Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. I wanted to do a video about the emotions of investing and the mindset for investors. Investing is a mind game more than a strict analysis and trying to foretell the future. People who are emotionally tough and do the right thing will do well when investing. Those that let their emotions win will do worse than they could. Bailing out at the very bottom for a good stock to make the psychological pain they are feeling stop is common after telling themselves that they are long-term investors as the stock falls. People hold on to the very bottom and then sell, wanting nothing to do with investing. This is called capitulation, and that's when the professionals jump in and take advantage. Conversely, buying more of a bad stock that went down because we don't want to be wrong and feel bad also ends poorly. So we do, quote, the right thing. However, it's not the right thing for the stock, it's the right thing for us. People will double down and buy more when they should take a small loss and move on, using their money for better purchases. People will also buy at the top of a market because it feels good and safe, not knowing that that is the point of the highest risk. At the bottom of the market, the risk is actually the least because you can't fall very far out of a basement window. Feelings should not enter the mind of the investor. The stock cycle is well documented. The stock market returns have historically followed a cycle of emotions, starting with strong returns when there is optimism and peaking when there is euphoria. When fear starts to set in, market returns turn negative and eventually bottom out when the investors are fearful. This cycle repeats itself as optimism starts to take over again. Risk is the greatest in the euphoria stage when everyone feels awesome. The point of maximum opportunity is during the anger and depression, often called capitulation. When times are tough, we want to limit our losses. When things are going well, we wish we had invested more. We all fear missing out. But when you're investing, giving in to fear is often a losing strategy. More often than not, investors with this mindset tend to buy high and sell low as they invest more in a rising market and pull money out of a falling market. Investors who have followed their emotions, joining the crowd of other emotional investors, have historically regretted it. Periods that followed investors cashing out of the market have provided above average returns, while periods that followed investors adding to the market have provided below average returns. The average investor gets the timing wrong. The two basic emotions are fear and greed. The first emotion is fear, selling when the stock went down. Ask yourself, will it go to zero? If you think the world as we know it is ending, you should be buying ammunition and canned goods. Otherwise, you should be buying stocks. The second emotion is greed, buying at the top, thinking it will go up forever. Buying overpriced stocks on sentiment because it's going up as other people pile in only because the price is going up, and we fear missing out or FOMO when all your friends made money is generally a bad idea. Stocks will eventually return to the fundamentals once the excitement dies down and people figure out that the stock isn't worth what it is trading at. Go against the herd and be a contrarian investor. Be fearful when others are greedy and be greedy when others are fearful, as Uncle Warren says. Be dispassionate. Will the investment go up from here? If yes, buy it. If no, sell it. I always like to say, buy or sell, there is no hold. Just because you own the stock already doesn't make it a better stock. And you shouldn't let the trading commission cause you to not sell a bad stock. Usually, it's not wanting to feel bad about having made a mistake and putting more good money after bad that causes investors not to sell a bad stock and to underperform the market. Just sell the stock and move on. Hope is not an investing strategy. Ask yourself, would I buy more stock today? If not, sell what you have. Don't hold it just because you have it. Also, don't try to get back to even. If your stock fell by 50%, ask yourself, if I didn't own the stock today, do I think that it would double? And if the answer is no, then don't expect something that fell 50% to recover back to where you bought it. Another strategy is to automate your purchases and don't try to beat the market or time the market. Based on what the market's been through during the past few years, I understand that you may have been hesitant or even anxious to regularly invest your hard-earned dollars. But history teaches us the importance of staying invested in good and bad times, and if appropriate, adding good investments to the portfolio when prices are down. That concludes my thoughts on the investor thinking and psychology. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.